Thanks, Doug. It's great to be with you in person in the studio today, and good morning to everyone on the webinar. If we just take a look at 2021 and what happened during the year, the very interesting thing, and something none of us would have predicted, is what the S&P did last year. A very, very strong year for the S&P, up 40% in rands, and that's really due to the fiscal and monetary stimulus we saw coming out of the US. Huge fiscal and monetary stimulus. But it really was a tale of two stories. With on the other side, you can see China down 15% in rand. And that's due to the new regulations that came out in China, and that really drove very negative investor sentiment. If we then turn to the local equity markets, the dual listeds on the JSE only up 3%, and that's a nice change. So the JSE really driven by local equities, and the dual listeds only up 3% due to Naspers down 18% of the year, and that's because of pressure in China. If we then look at domestic SA equities, they did very nicely, up 27% for the year, better than Europe, slightly worse than the US, but still a very nice performance. And the SA Equity Net Group Fund up 28%, so doing very nicely compared to its index and a good year. This is just the longer-term track record of the equity fund, and we can see that it's outperformed the index and peers over its history since inception. If we then dive deeper into the fund's performance, we can see over 1, 3, and 5 years and inception on an annualized basis, the fund has nicely outperformed its index. But what I find more interesting is if you look at the 3-year rolling performance of the fund, 74% of the time the fund has outperformed its index, and 60% of the time it's outperformed peer equity funds that are focused on the SA equity markets. So consistent performance over time. Just unpacking what drove fund performance in 2021, we had a large high conviction position in MTN that did very well for us. We've now pared that position back as we think it's closer to fair value. We did nicely out of diversified resources, being Anglo-American and BHP, that were strong last year. Also nicely out of the Platinum Group stocks, Amplats and Implats. And then in the South African market, our high conviction position and our favorite bank, Absa, did nicely for us. And we did nicely out of Liberty because there was a takeover bid by Standard Bank. On the downside, Northern Platinum hurt us slightly, and that's really around the RBP deal and the risks around that. And then gold was under pressure during the year, Anglo Gold under a bit of pressure, but we maintain our position there as a bit of portfolio insurance and a hedge against future inflation. So what are we looking for in 2022? From a global perspective, global growth still strong, forecasted about 4%, but slowing. It is still above trend compared to history, and so still strong global growth. We've seen the most generous action from central banks in the history of markets, and the question is, how does this play out? What will it do to inflation? Recently, we saw a very high inflation print in the States of 7%. So the question is, what's driving this? And that would be supply chain disruptions. We think that peters out into this year. Labor shortages in the States with very low unemployment rates, and the oil price very high at $87 currently, and whether that will ease in 22, which we think it will. This will drive what the Fed does and the speed and magnitude of interest rate hikes and the balance sheet runoff. The last question on the global front is Chinese growth and the regulatory environment there. We think we're getting to the end of the cyclical regulatory environment in China, although regulation is here to stay in China and globally. If we turn to the local focus, commodity prices is something we watch very carefully, especially platinum group metals, and that really helped our terms of trade in South Africa in the last 2 years, kept the rand strong and inflation low. Economic policy traction, what does the government do there? We've seen some structural change, but we know it's not nearly enough, but this could really drive investor confidence going forward. And fiscal policy, what does the government do around public sector wage increases and special grants we've seen during COVID? Do they become permanent with the huge disparity we see in South Africa? The last question is around the ANC elective conference in December 22, and who will contest the top position? Is there any challenger to Cyril Ramaphosa, which would be relatively negative if he doesn't win? So I've highlighted many of the risks globally and locally, But the thing to overlay and keep in mind is valuation. If we look at valuation of multiple markets, excluding emerging markets, which is that bottom line, from 2016 to 2019, it was quite a narrow disparity in the forward PE of various markets. We can see recently that has really widened out, with the S&P re-rating or the US re-rating drastically, and the South Africa de-rating. And that's why we still think they're very attractive opportunities in the local market from a valuation perspective compared to other global markets. This is just a proprietary index we put together of various stocks that are really exposed to the South African economy. And you can see here, compared to history, these stocks are still trading cheap, and we're finding great opportunities in the South African market. So how's the portfolio positioned at the moment? British American Tobacco, it's trading on an 8 forward PE, 8% pound yield, and we expect share buybacks going forward, which should really drive the stock. We have seen that start with a good start to this year. Naspers Process, you're buying Naspers at a 60% discount to intrinsic NAV, and we haven't seen Tencent trading this cheap in a decade. So we think it's a very attractive opportunity. SA Financials, we still have a position in banks, but we have started rotating out of them as we think they're close to fair value, and buying insurers where we've got a good feel for the back book, free cash flow yield, and they're trading at attractive valuations. Healthcare stocks trading at about 8 EV/EBITDA. We think as COVID normalizes, you see capacity utilization pick up there, operating leverage come through, and this should really drive earnings going forward. And then select resource exposure. Really, there we're very constructive on platinum group metals. We think as the chip shortage eases, OEMs will start producing cars, and the platinum group metal stocks are still trading at high-teen free cash flow yields. In the diversified space, we still have exposure, but a little more cautious, and we think they're trading close to intrinsic value. So just from a geographic exposure perspective, always interesting that we only focus on SA-listed equities, but only 37% of the fund is exposed to underlying South Africa. About 40% of the fund exposed to developed markets and 17% to emerging markets, and that's really driven by Naspers Process. From a sector exposure, the global consumer, 21%, that would be Naspers Process and British American Tobacco. Still exposure to SA banks, but that has come down over time. The insurance sector, we've built up exposure there. Decent exposure to resources through PGMs and the diversified resources. And then we built up nice positions through selective exposure to general retailers and the healthcare sector. Just in conclusion, this is the top 10 stocks in the fund at the moment. Going into 22, we think the fund is well diversified and really nicely positioned to produce very good returns for our investors going forward. Thanks, Doug. On that note, let's go to questions.
So everyone, just to remind you, there is a Q&A option on your screens. I see some of you have found it, have had a request for lunch. So I'm not quite sure how to answer that one from a technical perspective, but I'm sure we can, one of your relationship managers can arrange for that at some point. So Dwayne, you mentioned one of your big positions, you touched on China briefly there. One of the big positions in the fund is obviously Naspers, and with the regulatory changes that we've seen in China, are you still quite constructive on that position in the fund?
So very constructive. Firstly, we think we're getting to the back end of the current regulation cycle, as I said. And if you look at most of the regulation, we think it's relatively logical and in the best interest of society. So, the regulation, while it came out of left field, we think is actually good for the Chinese internet sector. Then if we overlay that into Tencent, which is 85% of Naspers intrinsic value, the current regulation really has a relatively immaterial effect on the cash flow generating ability of Tencent. Then on top of that, Tencent is trading at, let's call it a 16, 17 forward PE, if you take off its associate portfolio with a bit of a holdco discount. And that's as attractive as we've seen it in, a decade. On top of that, remember, when you buy Tencent, you buy the core business, but you're also buying probably the best venture capital company in the world. They've invested something about, let's call it $80-odd billion over the last decade in various internet ventures, and they've created almost a 60% IRR on that portfolio, which is unheard of. Better than most other venture capital companies. And there you would pay 2 and 20 for this. Here you're getting it as part of Tencent. So right now, and you're buying Naspers at a 60% discount on top of that, we think there's a great opportunity there.
And while we're on the topic of China, there's obviously a big outbreak now that they're coming across on Omicron, but there are signals now that rates will be cut there. What are your views on China? Is this going to be a positive for the economy, and is this something, do you see a strong trend coming out of this in the near future?
So look, I don't think an outbreak of COVID is ever positive for any economy, but we know Omicron does look like it's less severe than other strains of COVID. We've seen 2 rate cuts coming out of China at the back end of this year and back end of last year, early this year. That is obviously positive. I think it's more the message that China is giving us that they are willing to stimulate and support the economy going forward. There is a lot of worry about Chinese growth. People now saying it could be below 5%, which is relatively weak. But that being said, if we take selective exposure to China, like we are through, let's say, the internet company Tencent, they are less reliant on that stimulus than other companies. And we still think there's huge opportunity for growth within China and outside of China. And Tencent's focusing, 25% of the gaming business is now outside of China, and there's a huge focus on growing that business going forward. So probably less effect to a stock like Tencent, and could be a larger effect in what happens in resource prices, which are obviously much tougher to forecast.
And we'll definitely touch on resources later, but I want to ask you a quick question. Omicron, when it first hit South Africa, it obviously destroyed a couple of our holiday plans, but it did lead to a lot of anxiety in the market. I think we saw the rand sell off and a lot of SA Inc. counters sell off. That's obviously where the Laurium SA Equity Fund is trying to target. Can you just give us a brief description of how you traded in that environment around the end of November?
So when Omicron broke, you saw the banks and the insurers really get hit. We had witnessed 3 previous waves and the effect it had on banks, and we knew that the banks were very well provided. So ABSA, for instance, really was under massive pressure, and we took advantage of that. We were very comfortable with how well they provided and the effect that COVID had on the banks. So once the stock came under massive pressure, we increased our position there, and that's worked out very nicely. We then went and really spoke to a lot of experts, doctors in the field, across the country, and try to get a feel as quickly as possible, because we were in ground zero of what Omicron's all about. And we soon got the feeling that the Omicron virus wasn't as severe as previous strains, and this you would see, while there's a lot of infections, there's less hospitalizations. And because of that, we were very comfortable then increasing our insurance position, because we were comfortable that their mortality provisions were big enough and that Omicron wasn't going to result in massive excess deaths. And that's also worked out very nicely so far.
And I guess the next question is around some of your SA Inc. exposure. You have signaled there that you're seeing quite a lot of value when you compare SA Inc. Historically and relatively to other equity markets. Could you just give us a sense of what needs to happen for SA Inc. to really re-rate, and what kind of factors might drive that drive in unlocking that value?
Yeah. So in the South African perspective, we think you need to be quite selective. There are great opportunities in the market, but you have to be very selective at what you're looking at. And it must be a quality company with great valuation, and we're still finding those opportunities. If you're telling me what will really drive, or asking me what will really drive the South African market and re-rate it, things like if you could get Eskom working, so power production up, if you could really see good structural change from the government, so their policies improve, you could really see investor confidence from a market perspective and fixed investment perspective really being driven up, and that could really help growth in South Africa. What South Africa really needs is strong GDP growth above population growth. So anything that really drive that growth going forward could be fantastic, and we believe that could drive a re-rating in the South African markets.
I've just got a question here on BTI, British American Tobacco. That is a position in the fund, and there's just a kind of a question coming in here. What are the growth drivers in that stock, and what's your opinion on increasing menthol bans? So I guess what's your investment case there?
Sure. So when you look at growth drivers of BTI, really, you're going to continue to see volumes globally in the tobacco space under pressure as less and less people smoke. But obviously, they've got great pricing power, which is great in an environment that we're going into where you should see high inflation. So you're sort of seeing mid-single-digit earnings growth coming out of BTI, and that's pretty steady going forward. When it comes to the US, which is a large part of the business, and the menthol bans there, it does seem that the menthol bans have sort of been put on the back burner for the moment. It is a risk, and I mean, it could happen, so it's hard to predict what exactly happens there. But we have seen in other markets where menthol bans have been instituted that the smokers then move to traditional tobacco products. So we don't think you're going to lose your whole menthol market. Putting together or overlaying the valuation of BTI on that, we still think it looks like a very attractive opportunity.
Quickly turning our attention, one stock I also want to mention, it was one of the best performing stocks last year, so I think it's important to ask, and there is a question that's come on MTN, is like that rallied quite strongly last year, then they've gained a banking license in Nigeria, and that also propelled the valuation. Are you still holding it? Is that somewhere where you see value still?
So we had a big position in MTN. We thought it was very undervalued all the way from the bottom of COVID, where we increased positions. So it was a great opportunity. On the back of that rally, when they got the PSP license, which is really a mobile money license in Nigeria, well, in fact, it still has to be finally allocated to them, but it should be allocated, let's say, in the next 12 months. The stock had a very strong rally. And while we still like the company and think they're doing the right things, when we look at the valuation of the company now, even when we bake in a lot of value for the fintech business, we think the company is now trading very close to fair value. And so we've actually almost sold our whole position in MTN at this stage. On the back of that, you also have to keep in mind that there are huge risks with regards to the Naira and that devaluing. At some stage, the Naira has to devalue, and that's about, let's call it, a third of MTN's value sits in Nigeria, and so that'll take a hit. So we have to keep those risks in mind. And just general risks in a lot of the jurisdictions they operate. We have seen a lot of rent seeking by governments, so that's always a risk to a company like MTN.
Yeah, and I think that risk premium has to be baked into those multiples. But I think
Absolutely.
you sold out of that. Are you fully out of that position now?
We're now fully out of it.
Yeah, okay. PGMs. That's been a big growth story, particularly in SA Inc. portfolios. We've seen some of our competitors who've taken quite hefty positions in that sector do quite strongly. And a big question now is, will those PGM prices, is there still a lot of support for that? What are the risks to that investment case? And yeah, maybe you could just give us a brief overview of how you're thinking about PGM prices.
So when it comes to resources, always notoriously hard to forecast. That being said, we do think that PGMs have got support because they've been under pressure because of this global chip shortage, that supply chain disruption. And we think that comes to an end, and you should see that supporting PGM prices. The stocks at current spot prices are trading at very attractive free cash flow yields, so high teen free cash flow yields. So we've got a bit of a margin of safety there, plus, let's say, support for the actual metals. So we think it's an attractive opportunity in PGMs at the moment. That being said, we try and position it in the portfolio at the right size, just taking into account there is a lot of risk when it comes to forecasting the PGM prices. But right now, we're very comfortable with our position in PGMs and think there's at least another 20 to 30% upside in the stocks.
Yeah, because we were just having this discussion earlier. A lot of that PGM price will depend to some extent on how quick the unfolding or the transition to the EV or the electric vehicle transition will take, and how quick that'll be, because that's obviously going to be a negative.
Correct. So EVs, you don't use much platinum, or you don't use platinums in EVs, but what you do is in the hydrogen fuel cell. So it's really a balance about, what part of the transportation sector uses the hydrogen fuel cell, and that's for industrial applications as well, versus the EV or electric vehicle sector, which will really be smaller vehicles sort of driving around town. So that's obviously more like a 2030, 2035 story, but we're keeping a close eye on that, and we think that hydrogen fuel cells will be widely used as well, which will be positive for the platinum group metals.
Last question. Dwayne, what sectors, or is there a specific company that you are kind of most excited about in an SA Inc. context?
So when it comes to SA Inc., look, the hospital groups, as we mentioned, we think there's a great opportunity there. I mean, Omicron doesn't seem nearly as bad as previous waves, and as elective surgeries come back and hospitals fill up, they're trading quite cheaply, and we think that can really drive earnings. So that's quite exciting. There's specific insurance picks that have less exposure to mortality. If COVID, let's say there would be a fifth wave, we think look attractive. They're trading, I mean, they've underperformed and they're trading on very low multiples, and they're high quality franchise businesses. So we think there's opportunities in there. And then sort of selectively in the mid-cap space, we're seeing opportunities, and we're building 1 or 2 positions there where we think the valuation looks attractive and the opportunities look very exciting.
Thanks, Dwayne. That's all we have time for today. I hope that the audience really got a good overview of SA equity markets, and that, looking at those performances of South African equity markets last year, and looking forward at some of the potential performance, that you don't ignore having that kind of SA Inc. building block in your portfolio. So thanks very much, Dwayne.
Thank you very much, Doug. I enjoyed
Cheers.
that.